Becoming a profitable forex trader is what every young forex trader, either male or female, dream of. But there is a lot that comes with what profitable trader, becoming a profitable trader. It's not only the risk management, the money management, the psychology, but there is another key factor, which is what? The methodology. A trader that has a methodology that has been back tested and forward tested to have an edge in the market would definitely be a profitable trader when the T's are crossed and the I's are dotted. If you are that trader that has no methodology and has been looking for one, stick to the end of this video, because I'm assuring you, you're going home with a methodology that will put you among the 5% successful traders in this world. So guys, I'm so sorry I have not uploaded video on my channel, but I'm telling you, I'm back, fully back for more content. So please, if you like the content I've made before and this one I'm doing right now and the one I will do in future, please like this video, subscribe to my channel in order to help for the YouTube algorithm. Turn on post notification to get notified when I release content like this that will help you and I to grow. Remember, I'm not a professional forex trader, but I'm working towards it. As you can see, I'm sharing my journey with you guys. So I'm going to do the YouTube stuff. I'm not a financial advisor. Any topic taught on my channel is based on my knowledge about the smart money concept. So guys, I'm super excited to meet you guys again. So I'm going to let the intro roll in. See you in the next slide. Welcome back, traders. As you can see on my screen, in today's video, I'll be teaching you guys the SMC blueprint model. I call this model because it has a tradition that you are to follow. Once you follow it, definitely consistency, you're gonna become profitable. On my left hand side of the screen, I have the risk entry model, while on the right hand side of the screen, I have the confirmation entry model. Guys, I'm going to teach you guys the difference between these. I'm going to educate you and enlighten you in order to know which one suits you. Every trader has a way of trading. So I'm presenting you with two model. When I'm done with this, I will advise everyone that really want to get a model, that really want to get a methodology that will be trading consistently in order to become profitable, to do back test it and forward test it, in order to know your stand as a trader. Because if you don't do this, you wouldn't know how many what the win rate of this model and the win rate of the other model. So guys, the risk entry model. The risk entry model is a model when a trader enters a trade without confirmation. Much more like the aggressive traders. Why the confirmation entry model is a model that a trader enters with confirmation. If you've been watching my previous video, you should be conversant with these kind of diagrams, but I haven't really touched them much like that. But today I'll be breaking them down for you. The risk entry model, like you all know, it's this. I trade a smart money concept based on my own knowledge. So this is how the risk entry model is. If I'm to explain through light about this, now. You already know that before the banks, like I say in my previous video, before the banks make any move, they do they stop the retail traders. Now, when they stop the retail traders, what do? They leave behind liquidity, and you can see, rather they take out liquidity, because the retail traders do the retail traders present liquidity for the banks to do to take out. So if the bank wants to take this market that it was previously uptrend, they want to take it down, they'll first of all what, stop those retail traders that are trying to do what, sell from this what, their resistance, like they call. When they stop them out, then they do what, they bring price back down to break what, structure. When they break structure, then they take price back to mitigate their order that was open in order to what, to stop the what, the retail traders. Now for a risk entry model trader, he or she wouldn't wait for what, confirmation. Rather, they will do what, they will place their order on that order block that led to the what, to the break of structure. In order to what, to ride the market down. I repeat, a risk entry model trader doesn't wait for what, confirmation. Once there is a one break of structure, some people call it coach, but I call it break of structure. When there's a one break of structure, those that trade the risk entry model, they don't wait for confirmation. All they do is the what, they place their what, their limits, their sell limit order. Sorry, I use the only sell direction. This is the opposite. Whatever you do for the sell is what you do for the what, the buyers. So they put their sell limit order on that order block, on this order, that order block, this place that led to the what, to the break of structure, because they know that the banks will bring price back to that what, order block in order to close their what, already open position, which stop those what, retail traders in order to continue the market downwards. This is for the what, the risk entry what, model. Now for the confirmation entry model, from the word confirmation, this is a model that before you trade, you need to know that you need to be a patient what, person. Now when the market, it is just the same as, it is just similar like what, risk entry, but here we are waiting for what, more confirmation. Now in my previous video, like I said, when what I confirm as a change of trend is what, two what, breaks of structure. And you can see on this confirmation what model, we have what, two breaks of structure. That alone has given us the what, the confirmation that the market want to do what, move downwards. So the banks came into the market, they stopped the what, the retail traders that are willing to do what, to sell from this resistance. They stopped them out, and they do what, they brought price back down to break what, the structure. Definitely no one likes to lose money, even the banks doesn't want to lose money. So definitely they will bring price back to mitigate their what, their open in loss what, position, in order to do what, close it. Now when they bring price back to that order block that led to the break of structure, once that is done and it leads to another what, breaks of structure, my friends, have it in the back of your mind that that point where they made the mitigation is known to be what, point of invalidation. I use INV as the short form, which is the invalidation. The place where the banks brought price back to mitigate their what, order that was in a loss. We call it what, mitigation. Another name is what, point of what, invalidation. The name point, the word point of invalidation, what does it mean? It means that since the banks have closed their what, their sell position, rather their buy position, sorry, I've been using sell, their buy position, since they've closed their what, their buying position, they have no reason to do what, to continue the market upwards. Rather they do what, they have reason to do what, to continue the market downwards. So when they leave behind point of invalidation, we, the confirmation entry model traders, we already know that these banks are not willing to take this market up again. They are willing to do what, to continue the market sell. So we place our order at the what, the second what, the second order block that led to the what, to the second what, break of what, structure. And where do we place our stop loss? We placed our stop loss above, little above the what, the point of what, invalidation. That is what point of invalidation do to us, helps us as a what? Confirmation what? Entry model traders. Point of invalidation tells you where to place your what? Your stop loss. But in the case of risk entry model, there is no place. There is no what? Confirmation to tell you where to place your what? Your stop loss. The only thing you do is what? You place your stop loss above the what? The other block that led to what? To the first break of structure. So guys, I'll take you to the next slide to see what the keynote of this what? This risk entry model and what? Confirmation entry model. The keynote here is for the risk entry model. What I said, number one, it must what? Break a structure. In other words, it must have a what? One break of structure. Once you see one break of structure, all you need to do is to do what? Place your sell limit order or buy limit order on that first what? Order block that led to the what? To the first break of structure. Number two, it must what? Grab liquidity. It is only the banks that what cause what? Liquidity grab. If you see a setup, a risk entry model setup that does not grab liquidity, my friends, please don't take that what? Setup, because that you might be a liquidity. Liquidity tells you that the bank has already what? Done a movement in this what? Zone. So that is why a risk entry model must have what? It must grab what? Liquidity. And you can see in the previous picture I showed you guys that there was a what? A liquidity what? Grab. The next point, the third point on the keynote is what? It has no what? Point of invalidation. Like I said, risk entry model does not bring you, does not leave you behind, leaves point of invalidation what? Behind, because you don't know if that what? First break of structure is a liquidity grab or what? A true what? Break of structure. For the fourth one on the keynote, it has a what? A low probability what? Win rate. Guys, don't misquote me. Don't misunderstand me. Why I said it has a low probability win rate, it is because I have done my own what? Back testing and what? Forward testing. So I expect you not to take my words for word. What you need to do is to do what? Go back and back test this model that I'm going to teach you. When you do that, you now know and calculate your own win rate and see if what I said is either true or what? False. We might not have the same what? Answers. We might not have the same what? Numbers. But when you back test and forward test this model, you're going to see it for yourself. So I don't want you to copy and paste this. Rather, learn it and do what? Back test and forward test it to understand the model in order for you to know which one is suitable for you. The fifth one on the keynote here, it has a less what? Risk reward ratio. Yes. Risk entry model brings you what? With what? Less what? Risk reward ratio, because it doesn't leave behind what? Point of invalidation. Definitely you might place your stop, you definitely going to place your stop loss above the what? The first order block. So your stop loss might be a little big or small, not always. So it's going to present you with what? Low what? Risk reward ratio. And the last one here, it is what? It is long-term profitable. What do I mean by that? If you continue to trade this risk management consistently without changing or switching strategy, you're going to be what? Profitable in the long run. We're not here for the short-term what? Trading. We're here for long-term what? Trading. It is only those that are not willing to put in the hard work that come into the financial market and trade for what? For a short while. When they don't get the result, they call Forex scam, crypto scam. But they don't know that Forex trading is all about what? Consistency without what? Stopping. My friends, moving over to the what? To the next model, which is the confirmation model. Like I have in the first one, it must have what? 2 breaks of structure. When you see 2 breaks of structure, you should know that this is what? This trend has what? Has changed. So confirmation entry model leaves us with what? Must have what? 2 breaks of structure. For those that want to trade what? The confirmation entry, you must always wait for what? 2 break of structures. Now for the second one, it must what? Grab liquidity. It must grab liquidity. That is a ritual. It must grab liquidity. The third one, it has what? Point of invalidation. Like I've explained already, confirmation entry model leaves behind what? Leaves point of invalidation behind, because that is where the banks have closed their what? They are already in loss what? Position, be it in the buying or what? Selling. That is where they close the what? The order. So when they close the order, we the what? The smart money trader that trade the bank's footprint, we know that that is where our stop loss is to be. This is what? My own model. Okay, we have a lot of smart money concept strategy in the world. We have a lot, but this is my own what? Knowledge. So I expect you to take it. If you really want to what? Have a model, take it, back test it. You can also optimize it by putting other things that suit you. Okay, so no one should do copy and paste. After I'm done teaching this, go back test it, forward test it, and know if it suits your what? Trading style before you trade it with live money. It has high probability win rate. Yes, it has high probability win rate, but be mindful and be rest assured that you're gonna miss a lot of trades. But when you catch trades, there will be what? You will catch it to the fullest, and what? It will be what? High probable. Confirmation entry what? Makes you miss trade. You miss a lot of trades. Those that are in my free Telegram channel, you will see that there are trades I miss, but it doesn't what? It doesn't make me feel bad. Rather, I have to what? Live with it, because I'm ready to what? To face it, because I know it will come. So that is why you need to do back test and forward test to know everything about that what? Model. Now the next one, which is it has high risk reward ratio. It has a very high risk reward ratio. When you back test it, you will see it for yourself. It is what? Long-term profitable. Any strategy that is not what? Profitable, you and I are not supposed to be what? Trading that strategy. Our main reason here is to what? Make money, and we need to have a strategy that will make us what? Make money. No strategy that is 100%. No strategy. There is no holy grail strategy. All you need to do is what? When you have a strategy, backtest it, know the win rate, know the drawdown, know everything, and what? Trade that strategy consistency, and definitely you're going to see result. I am not yet a professional. I am also doing what? Replicating this attitude in my trading journey, because I want to become a profitable trader, and definitely I'm going to be there. So guys, with this keynote I've explained, I'm going to do take you guys to the chart so that we can see them for yourself very well, and I explain them to you. All right guys, let's go. Okay guys, welcome back to the chat. So before I do anything, I want to say something to you guys. I don't have TradingView premium account or this their account. I don't have it. I'm on the basic plan, so I don't have the bar replay on this lower time frame. So you know how we do it. I'm going to shift the chart to the right hand side of the screen, so the what has already happened in the future wouldn't be shown. So I'll be shifting the chart one after the other in order for you to see how everything unfolds. So you just have to do what, to be looking what at the right hand side of the screen on how I shape the candlesticks. Okay, so guys, okay, now let's get into business. Well, before you trade this before I trade this model, okay, I first of all I trade the London session and the New York session. So I wait for London session to do to open before I open my laptop on my chart. Okay, so I have a London session indicator that tell me when London session opens. It differentiate the London and the New York. So I'm going to on it. So I'm going to on it for you guys so that you guys will see that this is the London and this is the New York. So if I on it, I just on the London session. The blue line is the London session. Why the why the orange one, you can see, let me off the blue one first. Why this pink one rather is the New York session. The blue is the London session, which I just off. The blue is the London session, and the pink one is the New York session. So guys, let me put up the New York session first. Let's go with the London session first. So guys, let's see if we'll get examples on those models I just explained with you. So if I maybe for instance I came into the chart now, and all I want to do, I want to trade this model, be it the risk management and the risk entry model or the confirmation entry model. So I'm going to wait for the London session to open. So if I shift the chart small, now you can see this thick blue line shows that it shows the time the London session open. I'm a Nigerian Forex trader, so the London session open at 9 o'clock a.m. GMT +1 in my time zone. So it just opened. So now what am I going to be looking for the risk entry model or the confirmation entry model. So if I shift the charts, as you can see, okay guys, now remember our higher high and our higher low. Now guys, you can accept me, you can so you can bear with me that the market did grab liquidity here. When the London session opened, it came down to grab this liquidity with this wick. So it grabbed this liquidity and did if I shift the chart, and it broke this high, this structure. So we have one break of structure. I want to trade the risk entry model now. So we have the one break of structure here. We have the one break of structure. Yes. So I'm gonna put it here. The one break of structure. So now, like I said from the beginning, when we have the one break of structure, we have our liquidity grab here. We have our liquidity grab here, which is this. We have our liquidity grab here. So where is the other block that led to that break of structure? This is the other block here. This one here. This is the other block here. This is the one that led to the break of structure. It led to this break of structure. So we're going to place our order there for those trading the risk entry model. I placed my order, so definitely our stop loss will be below this the other block, so below here. So if I shift the chart, let's see if the market gets us in, and definitely you'll be targeting the high. So guys, let's see if the market gets us in. Okay, we are in the market already. We're in the market already. So let's see if it plays out. Let's see how it plays out. So it hits TP. So it hits TP because our target is the next high. So you can see it hits TP with using the risk entry model. This is what you want to look for. You want to know once the London session open, you want to look for that one break of structure, either to the upside or to the downside, and you look for that other block that led to the what, to the break of structure, then you place your order and you let the market do its stuff. As you can see, it was a win for us here using the risk entry model. So we had a 10 pips to stop loss. We had a 10 pip stop loss, and we had a 32 pip take profit, which is 1:3. That is the risk reward ratio, 1:3. So guys, that is for the risk entry. So let's see if we have the confirmation entry. I'm still hovering over. I can see. So let me move. I think I made some examples there, so it will be easier for us. Okay. So this is the London session open again here. So nothing here, nothing here. So when it got to this place, the market was making higher highs and higher lows, and this is our sorry about that. This is our higher low. So we wait for price to break there, and what happened? The market broke the structure. So for the risk entry model, and you can see here the liquidity was grabbed. You understand? The liquidity was grabbed. The liquidity was grabbed, which led to the break of structure. So we have two other blocks here. We have the first one, this first one, and we have this second one. So there are two. So when you have two other blocks like this, what you do is to place two orders on those other blocks. You place one order here. If you place one order here, place one order here, and you place another order here. You place another order here, but you can see the market didn't come back to this first order block, but you use this immediate order block to move downward. So you can see, and the market hits TP using the risk entry model. I haven't seen confirmation entry model, but we'll be looking for it. So this is just like 1:3 using you want the liquidity grab, the first break of structure, and the other block that led to that first break of structure. So we have, in this case, we have two other blocks. So we placed our order in the first one, and place our order in the second one, in the first one and the second one. So whichever one that picks us in, we let the market do its stuff. So let's go. So in this place, we have no setup here. The market, we have no setup here. Here is not no setup. So I'm just actually looking for an example. So when you go, just look for this thing, look for it during the London session and the New York session, then you back test it. So I already have some examples I've picked in, so I'm going to make this thing. I don't need to be showing you. I'm going to just bring the examples out like this. Okay, not here. All right, so we have another example here. You can see we have another example here. So guys, the London session opens, and what happened? And remember, this is our high, this is our high, this is our high, because it has pretty much candles to the opposite direction. So that is our high, and what are we waiting for? And this is our low here. You understand? This is our low. So we're waiting for that first break of structure, and you can see the market broke the structure here. So now where is the other block that led to that break of structure? This is this other block here. So if I use this one, that week, you can use this whole candle, but this week is also another block. If you go on lower time frame, you will see there's a selling candle below here. So if we place our order on that other block, you will see the market got us in. So now we are placing our stop loss below below that other block. You can place it, you place it below this other block. So no, below here for safe. So we have like 9 pips stop loss, and you are targeting the next high. So okay, you can place your stop loss here. Yeah, so like 3 pips stop loss and what, 19 pip, which is there about 6R, 1:6R, and the market what hits TP. You understand? It picked our order and hits TP. So now for the confirmation entry, I think we have a confirmation entry here. We have a confirmation. So permit me to delete this. That's for the risk entry. So permit me to delete that. So now for the confirmation entry, we have this first break of structure. Then the market came back to mitigate this what, this order block, which is here. Here turns to do what, our point of what, invalidation. I'll use the red. Here turns to be what, our point of what, invalidation. So here is our break of structure. Here's our first break of structure. So now we wait for second break of structure, which happened here again because this is our high. So we had the second what, break of what, structure. We have second break of structure. So now where is the other block that led to that second break of structure? It is this what, this other block. So if we place our order there, place our order here, and putting our stop loss below what, our invalidation point, which is here. So we have something like 5 pips what, stop loss, and we're targeting the next high. We're having what, 1:4. You can see we're having what, 1:4, and you can see the market picked our order and hit what, TP. This is for the what, the confirmation what, entry. You waited for the first break of structure, you waited for price to come back to mitigate that first break of structure, and you waited for the second break of structure. So now the second break of structure leaves you with what, invalidation point, where you're going to put your what, your stop loss. And you can see we have a 5 pip stop loss, and you target the what, the next high, and you can see the market picked our order and went to the TP. So fast forwarding to the next example. So in this case, I have another example here. The London session opened at this region. The market was actually making what, lower lows and lower high, lower lows and lower high, lower lows and lower high. So when it got to this point, the market did what? The market did what? Took out what, liquidity here, because it didn't continue the what? It didn't continue the lower lows and lower highs. It didn't continue the lower lows or what, and lower highs. So here turns to be our liquidity grab, and what, we have the first break of what, structure, this high here, this lower high. We have the first break of structure. We have first break of structure here. So now for the risk entry, since this is the first break of structure, what do? You place your what, your order at that what, this order block that led to the first break of structure. So we'll place our order and stop loss below. So let me use round figure, 7 pips, and you're targeting what, you're targeting the next high. Targeting the next high. So for this case, you just have 1.6 risk reward, so which is very poor, so I will, if you take the trade, no problem, but this is just 1.6 what, risk reward ratio. That's fine. That this is for the what, the risk entry model. So I want you to guys to go back test it, optimize it to know which one you prefer. So this is for the risk entry. You can see TP hits, the next target is the next high, TP hit. So permit me to delete this for the confirmation entry because I can see one. So after breaking the first, for this is for the confirmation entry, after price breaking the first what, structure, which is the first break of structure, price came back to mitigate what, that first order block, which is at this point. So here turns to be our what, point of what, invalidation, which is INV, which is point of invalidation. So now you wait patiently for price to do what, to take out that what, that second high. So which happened here, price took out that what, that high again. So leaving us with two breaks of structure. Now you now look for that second order block that led to the second break of structure, which is this week below, or this order block, whichever one you want to use, but I will use this week. So putting our order there, putting our buy order there with a, you can see our stop loss has been reduced from that 7 pips to 3 pips. This is the beauty of confirmation entry. We are targeting the next high. Now you have a ratio of, you have a risk to reward ratio of of 5.5, and the TP was smashed. You have a ratio of 5.5. You can see what I said about the confirmation entry has a high risk to reward ratio, while the risk entry have a low risk to reward ratio, but all are profitable when you trade them consistently for the long term. So guys, this is the examples I've given you. So you will go back, look at this, watch this video again, watch what I did, and you will see, when you go back, watch what I did again, back test it and forward test it, you would now know which one suits you. You will know your win rate, and you know your drawdown and everything. Optimize it. Then you now have a model you can now use to trade in the financial market, which will definitely put you among the 5% successful traders in the world. So guys, for those that stay to the end of this video, congratulations, you now have a model you can trade. If you want to trade the risk entry model, you just need one break of structure, either to the upside or to the downside, but it must grab liquidity. Then you place your order on that first order block. Then you let the market do its stuff. But if you want to trade the confirmation entry model, you wait for 2 breaks of structure. Then your order will be placed on the second break of structure that led to the second. The order will be placed on the second order block that led to the second break of structure, and you allow the market to do its stuff. Remember, your stop loss must be put below your point of invalidation when you are trading the confirmation entry model. So guys, I have a Telegram channel, free Telegram channel. If it's something you would like to join, click on the link below. You will head up into the Telegram channel, where I share my trade ideas. I don't share signals, rather I share trade ideas. Whatever if you take the trade, it's at your own risk. But these are the trades I trade daily basis, so you also get to understand how I trade the financial market using the confirmation entry model. So guys, thanks for 83 subscribers. Please don't forget to subscribe to this channel, turn on post notification in order to help for the YouTube algorithm. Without wasting much of your time, I'm going to catch you in the next video. Thank you and remain blessed. I love you all. Thank you very much for 83 subscribers. God bless you.